Step into the metalverse, a vast, ever-evolving realm where industrial metals take shape amidst shifting prices, market trends, and supply chain forces. But what does it all mean for you? Welcome to Cup of Joe. Named in honor of our founder, Joseph T. Ryerson, we help you navigate the metalverse, one conversation at a time.
Good afternoon, everybody. I'm Jason Pounders, the marketing manager for Ryerson. Glad to be with you today. I'm filling in for Mike, who's on vacation, much needed vacation with his family. So hopefully I'll do him justice. So welcome to August, Nick. How's it going?
I'm doing really well. How are you doing?
Doing well. Good to see you again.
It's unbelievable that Mike left us hanging for this month. Taking a vacation, unbelievable.
And a Cup of Joe Thursday at that. And join us today is Oscar Rivera. He's our vice president of Ryerson Mexico. How you doing, Oscar?
Hey guys, how are you? Good to be here.
Good. Glad to have you. All right, Nick, jump in, take it away. We've got a lot to talk about today.
Yeah, let's do it. So got a couple quick items that I want to, and I am not able to share my screen at the moment. Is there any chance you can dish that over to me?
Let's see.
Okay, I figured it out. We're good. Right. As always, we are doing this completely live. Let's go ahead and hop into these slides. Before we do, we always have to cover the legal ease. These are the opinions of Nick Webb, Jason Pounders, Oscar Rivera. These are not the opinions of Ryerson. Do your own research. But we got some great content for everyone today, and a bit of an update on what we're seeing with regards to the tariff landscape. So without further ado, I'm going to kick it off by giving just a brief overview of what we know, latest and greatest, basically from the reciprocal tariff standpoint. So this slide is going to look somewhat familiar to what we've covered in the last several months with a couple updates to it. So over on the left-hand side, this is hearkening back to probably 6-7 months ago. Scott Bessent, the Treasury Secretary, I'm reiterating some of the similar things I said in the last few months, but he basically said, take the top 18 countries that we do trade with around the world, knock off China, take the other 17, and those are the ones that we expect to have trade deals with in very, very short order. Well, I would say that, at least in my opinion, that isn't exactly what happened, because one of the first ones that actually started to get negotiated and sort of got resolved was in fact China. But we've got those 18 countries summarized here in this table, and I've sorted them by the volume or the dollar amount of the trade deficit that they have with the United States. So that is the deficit being they are shipping more goods into the United States than we are shipping to them ourselves. And I've colorized all of them now because what I wanted to do was highlight, when the market first got the reciprocal tariff rates back in April of 2025, there was really kind of a freak out session that some of these rates were much more egregious than what I think the market was expecting. And you had a lot of risk assets sell off, the stock market sold off, commodities sold off very heavily. And there really was kind of a temporary freak out. Well, lo and behold, they ended up sort of pausing things, saying we're going to revisit all these. And as we sit here in early August, we do have a better idea of what those rates are going to look like, though. And Oscar and I can certainly dig into this in a little more detail. It does constantly feel like it's a moving target, because it feels like all of these are still somewhat in play to be renegotiated, to perhaps go up, perhaps go down. But a couple that I wanted to really highlight, first and foremost, China, which is the elephant in the room with regards to trade and trade deficits. Their rate actually came down from Liberation Day to where we are currently sitting right now, from 34% all the way down to 10%. So maybe a bit of a head scratcher certainly to me, because that is arguably the biggest culprit that's ultimately trying to be addressed or rearranged within the global trade mechanism. And it's actually come down by 24%. And not only that, the latest rumors are that 10% rate may even get put on hold for another 90 days while the U.S. and China continue to negotiate trade deals. So bit of a head scratcher there. Obviously, very large benefit with regards to Vietnam. As I think we've noted in prior Cup of Joes, a lot of retail goods come from Vietnam. Very heavy trade deficit with them, but we do import a lot of things, under Nike, clothing items, things like that. That rate has come down substantially from 46% down to 15%. One that's, again, a bit of a head scratcher on the reverse side is going to be Canada, which Canada has actually gone from 25% up to 35%, at least for the time being. It seems like there's a bit of contention between the US and Canada at the moment, but it does seem as though, again, that's probably going to be a work in process. My expectation is that 35% is going to get negotiated down, but devil's going to be in the details on what kind of carve-outs exist there. And then a couple others on the ramp up side will be India and Switzerland, which from where I sit, I don't know that I exactly call them allies, but I certainly wouldn't call them enemies. And both of those nations got ratcheting up of their tariff rate. India specifically, it was highlighted that the president is not happy with the fact that India continues to buy large quantities of crude oil from Russia. There's a bit of irony in there because we here in the United States actually buy a lot of product from Russia as well, not oil, but we buy nuclear products, uranium. We buy a lot of fertilizers from Russia. But nonetheless, the president is not happy with the fact that India is currently making those purchases. So just in the last couple of days, they've heightened those tariff rates up to 50% for the time being. A lot of that's kind of tied into the Russia-Ukraine situation. Won't get too deep in the details on that. But I think the real highlight is all the way down at the very bottom, which is at least on a total weighted average of all of these top 18 nations that we do trade with or have trade deficits with, the overall weighted average rate has dropped somewhat materially from 29% down to about 19%. But what I would call is one of the head scratchers is going to be highlighted here in the next few minutes with our dear friend Oscar, which is Mexico. Mexico's got a large trade relationship, obviously, with the United States. I would certainly call them very much so an ally, very much so part of the USMCA alliance, and their rate hasn't changed from Liberation Day to where we currently stand. It's held steady at 25%. It's pretty interesting that of the nations that have gotten decreases, that's not one of them. But the last thing I'll show before we open it up and have a nice conversation with Oscar is the markets kind of are digesting it this time around in a much different fashion than where we would have been back during the first Liberation Day in April. Hopefully you can see the visual here, but when those Liberation Day rates were originally announced and everybody said, oh my gosh, they're so much higher than what we thought they were going to be, the stock market, commodities markets, a lot of markets really had a knee-jerk reaction. You can see just in a matter of a couple of days, this is the S&P 500, so this is a stock market index, dropped by about 12% really, really quickly. And it was only once President Trump tweeted out basically saying, this is going to be a work in process. This isn't going to happen immediately. We're going to kick things down the road. Only then did we start to get a rally, but we got a pretty robust rally and actually are now seeing a lot of risk assets back up right near record high levels. So you can see that, again, this is the S&P 500. We're within spitting distance of the record high prices that we saw at the end of July. So it seems like, even though we are seeing elevated tariff rates for most regions around the world, the market is viewing it in a very different light. So with that, I think that's probably a good point to stop sharing my screen. And Oscar, what are your thoughts at the moment? Let's talk specifically with regards to Mexico. When you look at that rate, you see 25%, you see it hasn't budged. You see some of those other regions around the world that, some of them may have gotten dinged a little worse, but many of the big ones actually got some benefits on the tariff rate. And any first thoughts on why that may be, or how that may be transpiring?
Yes, thank you, Nick. We all agree, there is no doubt, modern businesses operate in a very dynamic and unpredictable environment today. Our customers are facing increasing customer expectations, consumers demanding faster delivery times, greater product availability, more personalized experiences, growing complexities. Global supply chains are suffering from diverse regulatory requirements and geopolitical uncertainties. Economic factors, fluctuations in commodity prices, labor shortages, global trade dynamics. For many, many years, NAFTA, the old USMCA, offered all those benefits to companies. And it was a kind of an easier decision to move production lines or complete assembly lines into Mexico. Mexico represented geographical logistical benefits, proximity to the U.S., efficient logistics, transportation of goods back and forth from the U.S., improved supply chain management, control over production processes, and faster responsive to market demands. It was a 2-hour delay or time difference versus a 48-hour difference in China. So companies starting to realize that those are actual meaningful benefits, skilled workforce and cost advantages. Labor costs in Mexico, obviously, compared to the U.S., much lower. Help reduce operational expenses. That was the driving force for many companies. Favorable trade agreements. NAFTA worked for so long. I think what's happening right now is just it needs to be, it will be renegotiated in 2026, but it's something kind of setting up the new standards for the future. The operation in Mexico offered the flexibility that many companies needed, moving production from different locations across the U.S., moving inventory back and forth, support increasing demands. Today, things have changed. And I think as a company, we need to adapt. It's not as simple as it used to be. However, we have managed to offer customer supply chain flexibility with all this and resilience, which is a key component of the future. They need to continue to run their operations efficiently in Mexico. A lot of those companies invested in Mexico for the long-term benefits, not for the short-term gain. We understand the political environment today. It might be different in 3-4 years.
Sure.
We have more variables that we need to monitor, that's for sure. Tariffs, import programs, duties, NAFTA negotiations, political environments. The answer is not simple, but the complexity and ever-changing environment in North America will continue to provide challenges now and in the future. It will require more effort and analysis, careful planning, risk management strategies, but that's where we come in. That's what we offer our customers. Our experience of more than 20 years doing business in Mexico, it is complex, but they don't need to do it alone. We can help them.
So, Oscar, if you were to summarize, and I hate to oversimplify things, but if you were to take, say, like the last 6 months of business activity down in Mexico, would you say that things are the same as they would have been a year ago? Are they slower? Are you seeing people doubling down on taking investments or activity down in Mexico? How are you feeling, or how are customers feeling about the business environment right now down there?
Well, it depends on the industry. There are some sectors that we have seen a significant decrease in their demand, market-driven probably. Not only tariffs, it's market-driven. It's economy-driven. In other cases, we're seeing customers now expediting their moving of business lines or production lines to Mexico, doing risk analysis, proactively doing risk analysis, comparing supply chains from Asia, from Europe, from the U.S., and finished goods from transformation of the finished goods and so forth. I think we'll see an uptick in demand for most of our products in the following months.
Okay. So with regards to supply chains and how they would have been, obviously Mexico purchases a lot of foreign product, whether it's aluminum, steel, stainless steel. Are you seeing those supply chains reroute within the country? Are they moving more towards going within Mexico, keeping everything internal? Are they coming up to U.S., Canada? I guess how are supply chains responding in the short term given the turbulence?
We have been very proactive working with customers in doing that and allowing them to have the flexibility that they need to react to the market demands. To give you an example, we're buying material from a U.S. mill going into Canada for DC casting, and then coated in the U.S. and then bonded into the U.S. to be back in Mexico to supply a customer here. So It's a very creative way of doing business. We're exploring different ways of doing business, and that's what has helped most of the customers mitigate the risk in their supply chains and obviously keep them competitive.
Yeah. I'm glad you brought up that example, because that's one where, and we're seeing it within Canada as well, where supply chains may bounce back and forth over a national border. And there could be instances where that can cause stacking of tariffs. I guess within Mexico specifically, we've talked a bit in months prior about the IMEX program. Could you talk a little bit about that? Give a little bit of a background on maybe what it is for anybody who's new to the system, and then maybe any benefits or pitfalls that customers are seeing with that.
Yeah, regulatory compliance in Mexico is complex. No way around it. It is difficult. Includes labor laws, tax regulations, the IMEX program, environmental standards. No doubt they can be challenging for foreign companies to navigate, but we are here to help. We have many benefits to run an operation through an IMEX program. We have PROSEC, we have Regla Octava, Aviso Automático, and VAT certification, to name a few. The EMEX program you're mentioning, it's probably the most popular one and used by most of our customers. EMEX translates to manufacturing, maquiladora, and export service industry. This program replaced the maquiladora program back in 2006 and offers incentive to companies involved in the manufacturing and export activities in Mexico. The main element or the main benefit is the duty and tax deferral. So the EMEX companies temporarily import raw materials into Mexico, components or machinery, with the intent to transform or manufacture that product and then export it out of Mexico. And the benefit is that they will avoid duty-free and exempt from value-added tax, which in Mexico is 16%. So that is the main benefit of the incentivized businesses to establish operations in Mexico within the maquiladora industry by deferring import duties and taxes. So that's the benefit of the EMEX program.
So with that sort of benefit, it sounds like a pretty meaningful dollar amount for anybody who's either established previously or is considering establishing any type of operations down there. Are you seeing just a massive line of corporations trying to apply for this at this time?
It has been extremely difficult for companies to obtain an EMEX program these days. It seems potentially it may be no tariff barrier from Mexican government trying to retaliate against the U.S. for the tariffs. However, the companies have a probably 6 month period to obtain an EMEX program. Once you obtain the EMEX program, obviously you have to keep it up to speed, and every year it's subject to review.
Okay. So it can be somewhat burdensome process.
Yeah, for those companies that do not have an EMEX program and they have operations in Mexico, they have to work through the aviso automático. Think about aviso automático as a visa for materials entering into Mexico. Basically, what it is that for every product that you import into Mexico, when you don't have an EMEX program, you're required to get that permit at the border. And now, for that, you need a detailed description of the goods covered by the certificate, type of coating, casting number, technical, physical, and mechanical properties of the material, like a heat number, country of origin of goods, name of the certificate number, certificate date, issuance date, volume of goods, autograph signature or QR code on MTR. Now, keep in mind, a lot of the mills don't have their mill test report on an updated database. They use an old system, and it's been challenging for some of them to keep up to that. That's where we help, and this process could take the government 5 to 7 days to approve, and if the permit is denied, the process will restart. So you have another 5 to 7 days. So you could have product at the border for 2 weeks sitting in there to get the permit to approve because you don't have the EMEX for this Chapter 72 and Chapter 73, which are specific. So, for instance, aluminum, you do not require this aviso automático. For stainless, you do. For carbon, you do.
Okay. Interesting that there's a differentiation between products.
Yes. There is no production of aluminum in Mexico as of today.
Okay. So if we refer back to that table where we said back on Liberation Day, the original announced reciprocation tariff was 25%. That rate has not budged for Mexico, but it has for many other nations. Are you surprised that hasn't evolved in either direction at this point, given we've had 4 to 5 months for President Sheinbaum to negotiate?
Well, the tariffs, the 25% are for non-USMCA compliance of goods.
Sure.
USMCA compliant, they are not subject to that 25%. However, President Trump announced, I think it was August 1st, the impose of tariffs into Mexico, even though we had a USMCA. However, those were postponed up to 90 days. So it will be November 1st when they will be reviewing this. And the idea is to basically discuss the renegotiation of the USMCA for the future. But for now, those 25% or additional 30% will be a pause.
So it sounds like your interpretation of this, and I'm not putting you on the spot, but if we were to take a snapshot as of today, your interpretation sounds like maybe this is all an effort to kind of have a broader USMCA negotiated for something late 2025, early 2026 for both Canada and Mexico.
It seems to be that is one theory. there be basically, five or a few key sticking points in the U.S.-Mexico trade negotiations. And I think those are related to the energy policy in Mexico. Mexico is prioritizing state-owned companies. The U.S. raised concerns about Mexico energy policies, arguing that this is unfair and the state favors owned companies like electrical company and Pemex, which is the old company,
Yep.
and probably obstructing private investment from U.S. companies in Mexico hinders, like probably delaying, denying permits, revoking or suspending existing ones for U.S. companies. So that's a concern.
Okay.
And I think it will be a subject of the renegotiation. The other one, and again, I hate to be on the political things, but is the rule of law. A judicial reform in Mexico have concerns on the U.S. The judicial reform threatens to weaken the judicial independence, which is crucial for legal certainty and transparency in strong economies. The U.S. officials concerned that this might violate the USMCA commitments, especially those concerning on independent judiciary and labor courts. So I think that is also a topic that will be discussed, and it's probably something that will have an effect. Obviously, the USMCA will be renegotiated on July 1st of 2026, and a lot of things have happened in the meantime. But I think those are probably setting up the table for that negotiation. The U.S. has leverage over that, and here's another component of it that I don't know if people are aware, but the USMCA has a sunset clause, and the USMCA includes a sunset clause, which is Article 34.7, that mandates the joint review by all three countries 6 years after its entry into force. This review states a 10-year clock for the agreement expiration in 2036. If one or more parties do not agree to extend it, it could trigger a series of annual reviews that could ultimately lead to an agreement termination. So the U.S. has leverage. And if one of those countries, which in this case, the U.S., decides not to continue with the agreement, it will obviously generate a very big concern for Mexico. So,
well, and I know you don't like talking politics, Oscar, but sometimes we have to a little bit. It feels like if anything in the last 6-7 months, President Trump has been more eager to wield his power wand within the negotiations. So it may look very different here in about 11, 12 months versus where they were, say, 6 years ago when they originally set this up.
I think that the main focus of the renegotiation it will be on the auto industry, specifically for the rules of origin. Requirements dictate that a percentage of the vehicle must be originated within North America to qualify for a duty-free treatment. For instance, the USMCA increased this number from 62.5 under the NAFTA to 75%. So by doing this, I think that the U.S. is preventing Chinese companies establishing operations or manufacturing operations in Mexico in the auto industry and then jumping into the U.S. to attack the market.
Yep. So, I tend to agree with that. Yeah. Okay. So in our prep, we were talking. I was very surprised by this commentary. Maybe we can finish off with this, but we had talked about, are you seeing less inquiries, the same amount of inquiries, more inquiries for U.S. companies looking to kick around investment or business activities in Mexico? You want to share a little bit of anecdotal evidence around that? What you've been seeing in the last few months?
Yeah, we have seen an incredible amount of customers looking for risk analysis and risk assessments on their business operations in Mexico. I will say that 90% of the large OEMs have some sort of presence in Mexico, and we're helping them through. We have a lot of global resources, but the unique thing about all this is we have local deliveries. We're helping customers navigate through this. It's muddy, it's difficult, has changed, it's evolving rapidly, but we offer our customers, visibility. We have systems in place to offer them inventory visibility through Ryerson.com. So they have access to, our system, they have access to our inventory. Agility, we have over 100 locations across North America. We can react quickly to their demands. We can, supply the customer the product in Nebraska one day and the following day in Monterey with ease for them. We're working on collaboration with working together with our mill partners and customers to service our customer demands. We're in alignment with the same objectives: remain nimble, flexible, and most importantly, competitive. So we have seen a lot of customers that are moving away from potential tariffs in the U.S. to Chinese or other supply chains that they had in place, and exploring the Mexico as an alternative. At the end of the day, I think they will be analyzing all angles. That's kind of what the market is forcing them to do, and Mexico will still remain a competitive advantage over many other markets.
Which I was really surprised about, because I would have thought that it would have gone the opposite way and far less inquiries of moving into Mexico at this point in time. But the fact that there are actually more inquiries in assessing, business conditions, risks, costs down in the region was a bit surprising to me. But I think it is probably worth noting and highlighting the fact that, and maybe you already said it in a way, but just reiterating the fact that Ryerson does in fact have over 100 different locations all across North America, and for it might affect different P&Ls, different salespeople, but we are, as a business, we are relatively indifferent on where our customers ultimately choose to land and do their business operations, whether it's Mexico, United States, or Canada.
And we're in a very unique position. We can service the entire North American market. That's why we call, we have global resources with local deliveries. We can work in implementing the transition of businesses. We can ship material back and forward. We work with customers in determining the best supply chain or the most cost-effective supply chain, and we're in a very unique position. We have multiple conversations with different locations across the U.S. every day, exploring alternatives. Either one of them deciding to move the business, and some of them are just exploring and trying to learn about the market. And that's something we do. We have a lot of experience. We can help them navigate through the process.
Love it. So I think on that note, I think we covered the key points. There may or may not be some questions for you here in the next little, let's say half an hour. If you don't mind, hang on with us, hang on the call.
Sure.
I've got a few things on the macroeconomic environment I want to cover, some updates on the metal side that I want to cover, and then if there's any Q&A at the end, we'll handle that, and we'll do some parting takes at the end.
Sure.
Good.
Excellent. All right. So as we often do, love to give a global look at manufacturing PMIs, and perhaps not surprisingly, in the last month or so, we have seen a little bit of incremental softness in the purchasing managers indices. If you look along the top line, that global figure has gone from about 50.4 down to 49.7. If we look at a couple of the regions, looking at Oscar's region, it's had a couple tougher months. I'd say perhaps no surprise around that. A lot of that really kind of kicked off around Liberation Day. You can see the Mexican numbers got pretty deep red territory for both Canada and Mexico, but maybe even more so for Mexico. And it's, those two regions, Canada and Mexico, have probably suffered, unfortunately, at the expense of the United States kind of flexing its trade muscles a bit. Going around the world, you can see there's a lot of yellow, a lot of orange. That's just slight softness around the manufacturing economy around the world. We mentioned India earlier, that they were buying cheap Russian oil, and they're kind of getting a magnifying glass put on them. But nonetheless, their manufacturing activity continues to thrive. They've got PMIs up at 59.1, continues to be the bright spot around the world. Thus far, it seems like they almost don't care that the United States is calling them out for buying Russian oil. And it sounds like in the last couple of days, they've even said as much that they would look to ramp up purchases of other commodities, things like aluminum, things like fertilizers from Russia. So that seems to be getting a little more contentious between the U.S. and India. That'll be interesting to see how that shakes out. But the overarching summary is just slight softness within the global, and that includes the United States manufacturing PMIs. Now, I'm going to approach things a little bit differently, and I'm certainly not going to do it the way President Trump does. But in the next few slides, I do want to make the case, and hopefully I do a decent job of it, make the case for why Jerome Powell, the Fed president, should be considering rate cuts basically now. I'm not going to threaten to fire him, but I will certainly make the case. And that's despite the fact that if you look over on the right-hand side, I've got a tech bro, if you will, standing on top of a bunch of semiconductors and big piles of money. we showed the slide earlier that the stock market's at record highs. There are technology companies now that are worth $3-4 billion. You've got Meta out there paying $100 to $200 million for artificial intelligence coders like they're professional athletes. So why in the world would I be painting the picture that we need to have rate cuts when you have things like this going on? There's obviously a lot of froth going on in the economy. You've got housing prices at record highs. So there's no doubt about it. But nonetheless, I think if you peel back the onion and let me give a little bit of, state my case, I think hopefully we can come around on why some interest rates may actually be good for the manufacturing environment here within North America. First things first, if we go all the way back to 2000 and we look at ISM manufacturing, this is the headline manufacturing index. And again, anything above 50 is suggestive of growth. Anything below 50 is year-over-year weakness. And what you'll first notice, I drew in that red line, which is that threshold of growth versus weakness. And if you extract out I would say the head fake from January and February when President Trump first got elected, there was a lot of enthusiasm in the market. A lot of manufacturing companies thought we're going to get deregulation. It's going to be a free-for-all. Business activity is going to thrive. And it turned out to be exactly that, a head fake, because we got two points of positive data, and then very quickly we headed back into trough territory. And if we exclude those 2 data points, this is really the longest, maybe not in magnitude, but certainly in duration, the longest manufacturing trough that we've seen using this particular index. I would say if we overlaid an industrial production data, it's going to look pretty darn similar. I actually did it earlier today. It looks almost identical to this type of chart, which is suggesting that, yeah, we may not be in a deep recession. We may not have the great financial crisis on our hands. But in terms of just overall softness, it's basically been sitting in the manufacturing world for about 3 years now. And that's longer in duration, all the way back to that 2000 through 2002 timeframe, by about 12 months. So this is somewhat unprecedented in terms of just how long we've been in these doldrums. So that's the first thing I'll cite. It's not across the board, though. When we look across end markets, there are some bright spots. There's no doubt about it. Some of them aren't new. Things like aircraft shipments, HVAC, electrical components going into HVAC. Those businesses are doing quite well right now. And I think it's been publicized on the media quite well. And a lot of that's coming from the hyperscalers, the Metas, the Microsofts, spending tens, if not hundreds of billions of dollars into the construction of those things. One that came in as a little bit of a surprise is over on the far left-hand side. You got ship and boat shipments. That's coming in pretty strong in the most recent sets of data. As we understand it, a fair amount of that's coming from defense-related shipbuilding. So that's one strong point. But you do also still have the points of weakness in things like the construction end markets, energy, mining, and farm machinery. So there is still a story of the haves and the have-nots, but on the whole, the headline numbers are still a bit soft. Now, this is one that I think is important to point out, which is the divergence or the dichotomy between the services economy, which is going to be things like software, travel, leisure, hospitality, technological things. I was talking about the tech bros making all that money. That's going to be your top line. So that's the ISM headline services figure. The bottom line, and this is back to 2022, those are the ISM manufacturing data points. And they're almost a mirror image of one another, where you've got the manufacturing side of the economy that's kind of chugging along at a slightly weakening pace each year, whereas services are doing pretty well. And in some cases, services are doing extremely well. I will note that on the far right-hand side, services have converged a little bit, and we are seeing a little bit of softness on the services side of the economy as well. But hypothetically, if the United States was just a manufacturing economy, which I recognize we are not, it only represents 20 to 25% of our GDP. If we were just a manufacturing economy, I would make the argument that the Fed should have been cutting rates maybe years ago, despite the fact that we weren't quite seeing inflation back down to the headline inflation numbers back down to the target levels. Similarly, when we think about the Fed and whether or not they cut rates or raise rates, we have to look at two things. Obviously, inflation, and we look at this, which is employment. And if we look at just manufacturing employment, it's a very similar story, which is we've been in pretty weak territory from a manufacturing employment standpoint for the better part of 2 or 3 years. So again, I would say that jobs related data that the Fed would be looking for, any signs of weakness, it's really already been taking place within the manufacturing side of the economy. Unfortunately, the jobs data on the services surveys has actually held up a bit better. So that's kind of masking what's going on within the manufacturing world. Similarly, so the other fork of the Fed's mandate is inflation. And what we're looking at here is the core PCE. So that's going to be personal consumption expenditures. And this is kind of the Fed's favorite gauge of whether or not we have inflation or not. And the headline core PCE is at 2.6%. I came across this chart just a few days ago, actually, but it breaks down that core PCE by its various categories. So you've got services shown in the orange line, which is, as you can see, the bulk of it and has been the bulk of it for the last several years. You've got durable goods shown in purple. You have yellow, which is the non-durable goods. That's going to be like perishable items, food-related products. And then the blue section is going to be non-profits inflation. Back in 2021, 2022, no doubt about it, we had some durable goods inflation. We had metals prices going to record highs. It was kind of passed through whatever price increases you can get. We even saw it in obviously non-durable goods as well. And that was when we were getting inflation rates up in the 6, 7, 8% ranges. Fast forward to where we are now, though, and probably for the last 2 years or so, durable goods inflation is virtually nowhere. And if anything, I would make the argument that durable goods inflation is actually negative. So again, if you're able to hypothetically strip out and just say, how's the manufacturing economy doing from an inflation standpoint? Well, again, should have been cutting rates probably for the last couple of years from just a manufacturing standpoint. Now, again, I fully recognize that is not the vast majority of the country, but it is a decent sliver of the country. While we're on this page, I would note the fact that, within the services side of the economy, a lot of those industries, Facebook, Meta, Microsoft, those companies, they're much less reliant, and I've got another slide on this, but they're much less reliant on interest rate sensitivity. They're very cash flush, whereas manufacturing companies are having to rely much more on debt and things like that, which is making them more interest rate sensitive. So anything that the Fed is doing, I would argue, is going to be much more reflective of the manufacturing economy, not the services and technology side of things. But it's pretty crazy when you look at services inflation right now. Of the 2.6% in PCE, 2.3% of that is coming from services. So again, virtually none of it, 0.1%, is coming from durable goods inflation. That is not to say that we aren't seeing inflation in metals prices. We will get to that here in just a few. But on the broad swath of durable goods, basically non-existent for inflation. And then I mentioned borrowing costs. I'm just using the mortgage rate as a proxy for borrowing costs. This is the 30-year mortgage rate. You can see we're still at very elevated levels. And so this is, yes, the cost to take out a mortgage to buy a home on average, which is right up around 7%. Much more elevated than where we would have been back in 2020, 2021. And I'm not saying we need to get back down to 3% mortgage rates, but with elevated interest rates comes a more difficult time to borrow to buy a home, more difficult time to build a home, a more difficult time to purchase that piece of farm equipment that may cost $500,000 to $1 million. Farmers tend not to be very cash rich. They tend to be very asset rich. So if they're going to make a purchase like that, they may have to rely on debt markets, capital markets. And so that makes a lot of these more old school industries, in my opinion, much more sensitive to interest rates. Whereas on the flip side, we're hearing a lot of instances of these data center build outs that are getting done by the Metas, the Microsofts and the like, that basically those are just cash projects. They're just laying out the cash. They're saying, charge me whatever you need to, it needs to get built. And they're really not even leaning too heavily on the capital markets and the debt markets. So again, just really highlighting the fact that anything that the Fed does or doesn't do seems to have a much more pronounced effect on the manufacturing environment within our world. And then ignoring just the manufacturing environment, looking more broadly at all of the economy, we are beginning to see some of the employment data broaden out on a weakening basis. On the left-hand side, we've got the non-farm payrolls. So that is going to be all employment with the exception of, or I guess exclusive of farm jobs and government jobs. And that data point came in late last week at a fairly, I would say, pretty weak and surprising level. And then the other thing that the data point showed from the Bureau of Labor Statistics was a large revision lower in the last several months of this data point, which is basically saying that the jobs market, per the revision, is much weaker than we thought it was. I won't get too deep in this, but that is part of the reason why Trump decided that he wanted to fire the head of the BLS, because the revisions were large and not what he wanted to see. And then similarly on the right-hand side, these are continuing jobless claims. So this is anybody who's taken out unemployment insurance and not yet gotten back off of that unemployment insurance. In other words, found a job. And that number over the last 2 to 3 years has continued to pick up. Not drastically. It's not in sky's falling territory, but it is certainly showing signs of weakness. And this is not just manufacturing. This is the broader overall economy. The good news is my plead may already be felt within the market, because as we sit here today in early August, the probability, if you look here in the first and second columns, the probability of a rate hike in the September Fed meeting is around 91%. So pretty much baked in that the Fed is going to consider at least a 25 basis point cut in September. I think the jobs data that came out last week and is continuing to come out a little bit weaker than some had hoped for is starting to spark the concern of, okay, maybe we need to start getting back on the train of accommodating things and essentially ignoring the inflation data, which, as I mentioned, is mostly driven by services at this point in time. So it looks pretty probable that we're going to start to see a bit of a rate cutting cycle. How swift, how severe that is, we'll have to see as the data continues to come in. But the market is thinking that it's looking pretty darn likely for next month. Now, switching over to metals, I think I'll be somewhat quick on this because some of these are actually sort of dull with regards to news and price fluctuations. When we look at steel prices in the United States, this is looking at hot rolled coil in the U.S. in white. Europe is going to be in blue. China is going to be in orange. Seeing a very, very small uptick in prices within China, not much. Let's call it 30 or 40 bucks in the last month. We'll talk about why that could be. We're seeing a small bit of incremental weakness here in the U.S., though, again, not sky is falling. And I think the U.S. market has a pretty nice buffer around it currently with the tariffs that are applied to most other regions of the world. Though, as I mentioned, we have seen about, I'd say, $40 to $50 worth of weakness in the last 30 days on hot roll prices. But I put the pricing range somewhere in like the 800 to 850 range for hot roll pricing, depending on what index you're using. And then Europe's, it's had a bit of a slow bleed back down into the sub $600 range. So it's a market that continues to kind of struggle as we sit here right now. When I was mentioning on the China side, this is looking at a seasonal chart. So it's looking at basically year over year production of Chinese crude steel. And I tried to highlight the light blue line, which is going to be the current data. And when we compare that to historic, like the last 5 years, or we can compare that to the 5-year average, you can see that we are seeing pretty large moves lower in crude steel production coming out of China. And I would say if that is continue, I would say that's a very welcome surprise for the rest of the world, because as we've noted in prior couple of shows, China has a pretty severe overcapacity issue with regards to steel. They really don't need the amount of 10, 20, 30 million person cities that they were building back in the 2000s through 2020. So because of that, they don't need as much steel production. And so I think this is a somewhat encouraging trend. It's only a couple data points at this point, but if we compare the most recent steel production number to, let's say, the 5-year average, it's about a decline of almost 10 million tons per month. So you annualize that, you're talking about 100 to 120 million tons of production capacity or production getting taken out of the market, which they probably need to do a bit more than that. But it's certainly the early stages of what I think would be a nice sign to help balance supply demand globally. And perhaps no coincidence, and I don't want to give too much credit to the administration, but some of that decline did actually, in fact, start around when the administration got into place, started putting a magnifying glass on China, their transshipping, their overproduction, things like that. When we look at U.S. futures markets and we compare that to where scrap is ultimately trading, as if you tune in prior couple of Joes, we often say scrap plus 250 is sort of the fair value for steel. It's not really true anymore because there is a moat around U.S. steel markets right now because of the elevated tariffs. So maybe you call that number 350. And if you said scrap plus 350, that's basically where the futures curve is pricing right now. The futures market is in a slight upward slope, not massively. It's pretty dull as we sit here right now, which in my opinion, dull and steel these days is a welcome change from where we've been over the last 4 or 5 years. So I think we're in a range where 800, 850. I think that's kind of a range where both producers are able to make some money, be happy, and consumers are able to sort of say, as long as we don't get crazy volatility, they're able to absorb those types of prices. They're significantly lower than where we would have been a year ago, 2 years ago, 3 years ago. And I think this sort of feels like we're in a relative happy medium. As soon as I open my mouth around lack of volatility, we'll probably get something that happens that causes rampant volatility. But for the time being, it's a pretty calm market. And from a production side of things, U.S. steel mills are being somewhat responsible in not overproducing to really flood the market. They're kind of keeping things range bound between the 75% utilization rate and the 80% range. Looks to be somewhat capped around there. If prices are to further soften, I would expect that utilization rate to come down a little bit. But for the time being, it looks like 75 to 80% utilization rate is going to be the name of the game. To just kind of try and maintain decent margins at the mill level and not get too egregious in taking prices too high for consumers of metal. I'm going to quickly breeze through stainless and nickel because there isn't a whole lot new to report. We're still kind of in that right around $7 per pound range on nickel, which is keeping surcharges subdued at relative to 5-year prices, pretty low levels. We saw a little bit of a move higher in the last quarter in chrome prices, but again, pretty stable, pretty low prices on surcharges. We did, by way of the tariffs being put on imports, we did see some base price increases that we highlighted last month in Cup of Joe. Those, at least in part, look like they're sticking in the market so far as those tariff rates remain in place. And what's weighing on nickel prices or what's keeping things down here around this high $6, $7 range is nickel inventories. Nickel production coming out of Indonesia continues to provide ample supply and maybe a little bit of excess supply into the market. You can see when we're looking at nickel inventories, 211,000 tons, up substantially from where we would have been just a couple of years ago. And it's the pace of which has slowed down a little bit. And I think part of that's because we're seeing such pressure on prices, but nonetheless, it is still creeping higher as we sit here today. On the aluminum side of things, we are seeing pretty robust moves within Midwest aluminum. Midwest aluminum, again, being the summation of the London Metal Exchange price plus Midwest premiums. Most of that movement is coming from, nearly all of that movement is coming from the premiums themselves, which those premiums, again, that's reflecting the cost to get aluminum ingot into the Midwestern portion of the United States. And that's going to be reflective of tariffs. And with tariffs currently at 50% on ingot, that is causing premiums to be, I don't want to say artificially elevated, but just tariff-induced elevated. And you can see that if you look back over 5 years, yes, there's always been a bit of a premium between U.S. markets and the global price, the London Metal Exchange price, which is the white line. But that spread has widened pretty substantially in the last couple months. But again, all of that's going to be on the back, nearly all of that's going to be on the back of the tariff-induced premium move. Now, as we look at futures for premiums, it's fairly similar to where we would have been last month, although it's just the difference would be the spot prices come up higher. The spot price right now is up around 72 cents. When we look at the futures market for, say, like the calendar year of 2026, the average market is right around 60 cents. So there's about a 12-cent downward slope, or what we call backwardation, within the futures market. What is that implying? Well, I would say that's implying that somebody in the market or some group of people in the market believe that we may see some exemptions on the importation tariffs for aluminum. It's not guaranteed, but I would say that is what's being priced into the market. Because if you recall from last month, if we assume the 50% tariff is applied to every nation around the world, that's kind of what the top of these two examples assumes. we could back into a rough estimate that premiums could go as high as 73 cents. And if you recall from just a few minutes ago, I mentioned that the current spot price is sitting right at 72 cents. The spot market is basically pricing in a full 50% tariff into ingot as we sit here right now. The risk is, and it wouldn't take much, but the risk would be, let's say the United States strikes a deal with Canada and Mexico and says, okay, fine, we'll take Canada and Mexico aluminum tariffs down to 0%. You could see just those two nations having an impact of about 43 cents pretty instantaneously. And if you don't believe me, look no further than the copper market, where we actually saw something like this. Pretty unprecedented. I would say this did catch a lot of those in the market off guard. Depending on where you sit within the market, this could be a very good news situation, could be a not so great situation, but just saying what it is. The white line shown here is the COMEX copper price. So that is going to be a tariff included price for U.S. copper. That's the COMEX market is typically what's used to benchmark against U.S. copper prices. The blue line is going to be the London Metal Exchange price of copper, so more of your global price of copper. And what you can see is since January, with Trump getting in office, that premium between the U.S. price and the foreign market had expanded. And that was on the back of the expectation that a 232 investigation was going to find that, yes, in fact, the copper industry in the United States is being unduly punished by dumping or whatever it may be. And the implementation of tariffs would have to be put in place. Well, the U.S. did in fact rule that tariffs should be put in place, but the devil's in the details. The 50% tariffs are only going to be applied, or at least as we see it here right now, are only applied to finished products. So things like copper rod, copper tubing, copper wire, things like that. Excluded from those 50% tariffs are refined copper. So that's going to be copper cathodes, copper ore, things like that. The things that are traded on the COMEX copper exchange contract. So almost overnight, in fact, it was within minutes, the price of copper dropped by about 20%. You can see it on the right-hand side of this chart. We went from about $5.60, 70 cents, all the way down to just below $4.50 in a matter of minutes. Hundreds of millions, if not billions of dollars were probably gained and lost at that point in time. But it was all due to the fact that refined copper is being excluded from those tariffs. So coming back to aluminum, something like that could happen. I'm not saying it will happen, but that is, in my opinion, why we're seeing a little bit of a backwardation or downward slope in the futures market for premiums, because that risk is out there. And unfortunately, we've now seen it play out in the copper space, which, again, depending on where you sit within the supply chain, what types of products you're buying, this may be a benefit, this may be a pain point. But again, we just try and tell it as we're seeing it. So with that, that's really where I will leave it, unless there are any questions from the audience.
We have one about aluminum. I think you covered it there. And okay. What's going on in the market and anticipating a price drop. So
yeah, it seems like one of those things that it's almost as simple as just watch the trade discussions between the United States and Canada and a bit with Mexico. And if those seem to be going better, it's almost like you see pressure on Midwest premiums and aluminum prices, because there'd be an assumption that a deal is going to get done and tariff rates are going to get alleviated a little bit. But if it goes the opposite way, the opposite is also true, where if all of a sudden, the administration gets mad at Carney for whatever reason, the opposite happens as well, and futures actually move a little bit higher. It's a heavy political game right now, and
yeah,
we just have to watch the headlines, unfortunately.
Yeah, stay tuned.
Yeah.
Okay. All right. I guess, Oscar, any closing thoughts or comments on crazy tariff world?
No, not really. I think we pretty much covered a lot of ground. Maybe just to mention, we have 5 locations in Mexico, and I think I failed to disclose where they are. We have one in Monterrey, one in Tijuana, one in Mexicali, one in Hermosillo, one in Querétaro. Pretty much cover the entire country, and we can service customers pretty good out of any of these 5 locations. Other than that, I don't think I have anything else. Thanks for the opportunity.
Yes, good to have you. Nick, closing words.
Well, first of all, Jason, you crushed it today. I thought you did a wonderful job. Wonderful job filling in. Hopefully, Mike was able to tune in from the beach of whatever vacation spot he's tuning in from. But no, I'll sort of just piggyback off of what Oscar said, which is, and this is more broadly across North America, because Ryerson does have 100 plus locations all across North America. If you are considering any risk analysis, cost analysis, moving operations, or changing supply chains, keep us in mind, because we've got the ability to help in any of those locations. Or if it's even supply chains for offshore non-North American product, we have the capabilities and the abilities there. So we want to be flexible. We want to be accommodative with you. Our sales teams and procurement teams will obviously work with you heavily on all those things, and we look forward to doing so.
Yeah. All right. Well, with that, appreciate the time today, and we'll look for you next month here on Cup of Joe.
Thanks, everyone.
All right. Thanks, everybody.
Thanks, everybody. Thank you.